Welcome guys, it's Crypto Burp here and welcome to the very first episode of Weekend Trading School. It's my pleasure to meet you all for this very complete course of technical analysis. Let's get through the short agenda to know where we're heading for this very session. So we will start from short info for about the project. So how did it come up for it to appear at all? Its reactivation practically. Then we move on to introduction to financial markets. Subsequently, to concepts, principles, and phenomena of technical analysis, charts and data representation in financial markets, measures, indicators, and systems used in technical analysis, highlights and challenges, the pros and cons for TA, summary and credits. So let's get it rolling. Let's get it rolling, guys. About the project. So technical analysis of weekends. This is like if I were to shortly present the whole concept and idea for the course for people, then I would say definitely for it to be the technical analysis on weekends, especially created for those busy guys, those busy burbs that are working their asses off for regular 9 to 5 jobs, because this is the reality, right? Every trading needs to be very often backed by every trading activity needs to be backed by some independent, salary, money inflow to the portfolio, right? So that it does not necessarily 100% make you a professional trader, with not practically knowing the features and basics and principles of technical analysis as a whole, just to be next to fundamental intermarket analysis for the complete market analysis background. So complete course of technical analysis, we will get episode by episode, one by one, through the whole course, complete course. Every corner would be analyzed, every corner and section and chapter from most popular books and materials that you can find all over the internet, in your libraries for some financial universities, let's say. It's all there to be found for you, and it's all gathered here in some kind of a pill. So when it comes down to who will be the host for that, then it would be me. It would be myself. It would be my pleasure and honor to meet and greet you for Weekend Charting School episodes, next to my technical experts that you can see daily posting and helping you in the bird nest, exclusive nest club at least. Low price model for the bird nest enthusiasts, which is $9.95 for that. Like the whole plan and the whole game was from the very beginning for Weekend Charting School, next to Trading Therapy and Social Media Pro modular packages that we have recently introduced to on our website at www.theburbness.com, was to be accessible, available, and affordable for those that simply don't necessarily want to pay a lot for becoming an exclusive member. So it only takes I keep repeating that because this is the truth, practically less than a single Starbucks visit for you and for your friends to actually get the monthly course of technical analysis. So let's roll it, guys. Let's roll it. For the introduction, for the very first part that I'd like to discuss today for this very episode, would be to get you to know what the financial market is as a whole. And if we were, my approach is always to start from an understanding and comprehension of the definition for any term, for any phrase that we would be touching and discussing, right? So starting from the definition, it's definitely so financial market would be the type of market that people would trade some financial instruments, namely securities and derivatives, right? And securities are types of legally allowed instruments being like in Poland we call it like valuable papers, right? So these would be stocks, this would be some bonds, some documents that would allow you, that would present you with some bought value for that. And next to the derivatives that are practically the contracts, right? These are the contracts like you can all over the internet see and read for the futures, for the forwards contracts, for option swaps, right? And these way to manage your financial risk, because every investment, every financial activity is always bounded with risk management. This is pretty much inevitable, right? Because every investment brings the whole risk for potentially, you can win but you can lose as well. And hence people were smart enough to introduce to the traders derivatives. And these are contracts. These are contracts that are like their value is deriving pretty much from value of another type of asset, right? So let's say you don't need to buy like a bar of gold to be able to trade gold, right? Because you can, let's say, go to the futures contracts of, I don't know, XAU, right? And be able to still trade gold as a commodity, but in the form of a document. Because if you buy go long or short for the derivatives, you practically go and long and short contracts for whatever you want to go with, right? If this is a derivative of gold, then you can simply just trade the document, allowing you practically to be the owner of the asset, right? And hence we can present a short definition for the derivative to be a financial security with a value that is relying pretty much and deriving from another group of assets, right? So this is like something being derivative of another asset, right? So this is not the very asset, but this is a derivative from this asset, which means that you're not necessarily trading bars of gold, right? Because this would be pretty much for logistics pretty much hard to do so with other traders from the other half of the globe, let's say. Then you can trade documents and contracts practically for that. And the economic nature for that, it's all coming from the demand-supply relation, right? And trading happens between people, between parties to the market, to the buyers and sellers. I mean, there's always when you want for some reason and desire and demand some good, then you need to find a supplier for you to actually provide you with the good, right? For some agreed price conditions. So hence we can definitely say that this is a play of demand supply, right? This is a play being about trying to keep the balance between the buyers and sellers. And this way we can, knowing this perspective and understanding the fact that there are parties that want to either buy and get in possession of some goods, and at the same time there are another parties, the counter parties, that want to get rid of these goods, right? To have money for that, the money equivalent. When it comes to types of financial markets, we can definitely, amongst others, have those such as capital markets, right? Capital financial markets that are presented with stocks and bonds, commodities, as I mentioned already, derivatives, futures and forward contracts, forex, the foreign exchange, the cryptocurrency as well is a type of different section, exposed in a different way, for the cryptocurrency being type of financial market, pretty much formally. And to be able to read financial markets, you would need a different set of data. You would need a different set of knowledge, of experience, of market reading abilities and skills, with the whole background that it's coming with it, which means that we need to be aware that it's not only technical analysis, but it's as well fundamental analysis that is different, and intermarket analysis that is kind of like this glue between the previously mentioned ones, right? So with the whole setup of technical analysis, fundamental analysis, and intermarket analysis that, for example, includes some market sentiment analysis, it all comes together, right? To be able to use it to trade successfully. And for the concept of technical analysis, again, starting from the definition, right? So I mean, I'm always starting with the definition, guys. I mean, because whenever you talk with people, whenever you talk to some people about some, not necessarily 100% known to the majority of world, living guys living on the world, there always needs to be a proper understanding of definition, right? For my very engineering background, I'm very pressing this hard, pressing this this definition part, knowing the definition of actual understanding what's behind the words that we are using. People are not aware of the meaning of the words, right? So I would definitely push you guys to focus on understanding the whole concept from the perspective of definition. And if you ask a person about what is the definition, what the definition is for the technical analysis, then what you should hear, it would be the study of price history and movements that recorded in the past, right? And this is it practically. I mean, this is kind of a science, right? This is a mix of sciences that are contributing on a similar level, let's say, for behavioral economics, for sociology or sociology, no matter how we call it, psychology, mathematics, because if we want to apply some quantitative features to that, if we want to count things, right, present something with numbers, then we need to use maths to that, obviously. And so yeah, but behavioral economics, like the regular rules of economics, not only behavioral aspect of that, is definitely a part of technical analysis to be able to present the complete study of price history and movements for a given instrument, for a given asset, and to be able to spot some patterns, some trends, because technical analysis is all about trends practically. For the short history, we were having three somewhat independent streams practically of discovery of technical analysis, of discovery or invention even, right? Because it was more for people to invent this science, this type of science. And for the Europe, it was a Dutch guy in 17th century, Joseph de la Vega. And I mean, he was a Dutch guy, and these were the first recorded documents for his portfolio that are known, discovered actually after years and decades, that were showing that this guy was trying to come up with somewhat of market reading skills or market reading notes to analyze potential studies for the trends, for ways to practically gather the knowledge for the markets to be able to trade it, and hence increase the portfolio size, obviously. For the Asia, it was Munehisa Homa, a guy from Japan in the 18th century, the actual inventor of candlestick charts, right? And of candlesticks. And these were this is like a very let's say important. I mean, all of these are practically equally important because they were serving to different parts of world practically, right? And as for Joseph, from 17th century, it was for Europe. Then for Asia, Munehisa Homa, right, for Japan, for the eastern world, and for the western world, it was Charles Dow from the one guy from the that was to be known for Dow Jones Industrial Average later, right? He was the contributor to the Wall Street Journal, practically, where he was posting his notes, sketches for market reading and comprehending. So this was like a short background, historical background for that. For the nature backgrounds, as I said, for the types of mixture of fields of sciences, and social sciences and sciences, as per mathematics say, the behavioral economics, including the economics, obviously, that you can apply different theories of economics, the efficient or inefficient theories of markets, sociology, to understand, for example, like crowd psychology, that as well matters for psychology part here, and mathematics, as I said, to quantify these. And there is a popular known random walk hypothesis that practically means that prices, the hypothesis states that prices are completely randomly forming all over the world, and that people can barely predict anything regarding the prices. But because, let's say, if the price, what is the probability for price to, I don't know, for a given instrument to increase its value by 50%, like compared to today, if we want to see that tomorrow, right? So can we really influence that? And so there are parties, there are hypotheses, let's say, guys who believe in that hypothesis to be true, and hence this is like not really like a competition, but something opposite, in opposition to technical analysis, because technical analysis says pretty much that based on the history, we are able to predict somewhat, to a certain extent level, the future probable phenomena, right? So this is a game of probabilities. So for random walk hypothesis, and more of behavioral, economics parts as well, for some of them, this would be a random walk hypothesis that would say and state, on the contrary to technical analysis, that prices are forming in a completely random way, and people can barely read anything from that and project it, hence, right? So that's it. I mean, but it's obviously mistaken. I mean, there are to every hypothesis of this kind, we would find some arguments, some reasons to be somewhat logical, but it's not true that prices are forming practically. It's a fake statement that prices are forming completely randomly, because it would mean that the yesterday's price would be completely without any effect and result and influence for the price that is forming today, right? And is being formed today. So it means that it would be if it was completely random, then one day we could see, I don't know, buy a sandwich for $5. The another day we could possibly randomly buy the sandwich for $100, right? Because the prices are steered randomly by the market, which is completely senseless alone. Moving on to principles and phenomena behind it all. There are three main principles and hence phenomena for technical analysis, as a way of reading the markets, and that we need to know and be aware of, to be able to read them correctly. The first one says the market discounts everything. So it means that any event regarding that is happening all over the world, let's say at this very moment, is definitely influencing the market that we trade, right? And it means that, let's say, any type of news that comes out would be discounted by the market. That means that market would not be pretty much staying market reject would not reject it for the type of event, let's say, because if there comes a news that, I don't know, the president of some country dies, right? So this would definitely influence the economics. This would definitely influence the governance of the country, and hence the whole economy of the state. And this could be, the reason alone to say that any event happening within the market is discounted by the market, which means their market is like a self-accounting model that is able to let's say implement any event results into the market itself, right? And this is a reason for very often for the price of a given asset to change, right? And apart from that, we need to realize that prices move in trends, right? There are 3 different types of trends following the Dawes theory that we would be discussing in another episode. And one of it would be the uptrend, the downtrend, and the horizontal trend. So practically, we can spot different types of trends all over the market. And trends need to be understood practically by this sociological, practically, events, phenomena, in communities, in countries, or in simply all over the world, that there is a repetition of some behavior between the parties to the event, right? So let's say the trend could be, if you are waiting in a queue, I don't know, to buy a morning coffee, right? So that would, and there, if there is like 10 guys, 10 people, the group of 10 people, right before you, right, in a queue. So this would make it a short, in a way, this would make it a type of trend, right? There's some repetitive pattern that you can spot in all over the world. So let's say if prices of given instruments, I don't know, let's say indexes for S&P 500 or Dow Jones Industrial Average, right? We could say definitely that for years, for decades, we have been consistently increasing the value, the size of economies, the value of the indexes, the points. So it means we are in global uptrends practically, right? So if there is not a complete random approach to trends, we are able to spot uptrends, we are able to spot horizontal trends, and downtrends. So there needs to be some kind of a repetitive behavior behind it, right, to make it a trend. And trend itself is as well a statistical expression, is a statistical phrase, term that is correlated very very closely with normal distribution as well, but with standard deviation, right? So the trend would be this linear, let's say, it's not extrapolation, but this is like a linear alignment for set of data that would look more or less random, presented in a graphical way in a chart, right? So let's say if you are approaching to test the heights and to research on heights of guys in the classroom for the high school, let's say, then it would go a different set of data. Let's say for we are in Europe, in Poland, so let's say in metrics, and in our metrics it would be, let's say, 1 meter 75 or 1 meter 85, 1 meter and 90. There would be some people having the bringing the height of 1 meter 60 and so on. So if you combine all of that and present that in data, as a data in chart, then you could practically find a kind of a trend, it depends on the class, obviously, right? But if you compare the growth, the increase of the height, like from between years, let's say for the very first grade that they come and when they leave their schools, so you could see and spot in complete and constant increase in their heights, right? So this would make it a trend. This would make it an uptrend. And if you combine all of that and see some repetitive, even like events or phenomena, then you can call it a trend. Yeah, I wanted to break it down for you very clearly, guys, because this is the main, let's say, word phrase that you would be attracted to in technical analysis reading. And the third one principle would be about the cycles theory, and the fact that history repeats itself. I mean, this is a factor and assumption even more, right? That there are cyclic events and phenomena going all over the markets. If you go and compare throughout the ages and centuries, compare like some global events phenomena like wars between countries, right? So we can say definitely that wars are occurring to people throughout these centuries with some cyclic form. Let's say if you compare World War the first and World War the second, right? So it will make a cycle of of 20 or 30 years, let's say, right? Depending on the country somehow. And yeah, so it definitely, alone for the fact, I mean, I will bring this engineering point of view here as well. We are consisting of matter, right? The matter, namely the atoms, the particles, the electrons, protons, and so on, and quarks. And for this reason, I mean, every part of the matter vibrates. Every element of the matter vibrates, and vibrations are nothing less than, but practically cycles, right? Every vibration is a kind of a cycle. When it swings up and down subsequently, cycle after cycle, in a repetitive form. And if every part of the matter that we are consisting of as people is vibrating and making and working in cycles, then we as people are working as cycles, right? In cycles. So if people, being the participants and actual creators of markets, of any market in the world, are underlying and undergoing some cyclic events, so hence we got the practical logical extrapolation of the assumption to for market cycles to appear all over the world, because people work in cycles, right? At least you can just go for the cycle of birth and death, right? This is the life cycle practically. So this is the market discounts everything. The price moving in trends and the cycles of them are definitely the principles that need to be known for a technical analyst. Let's go for a short 1-minute break. Okay, let's roll it further. Let's go. For the charts and data representation. So to be actually able to read anything from the financial markets, we need to know two very aspects to be able to analyze the markets and events. We need to know the dates, we need to know the timeline, and we need to know the price history, right? So we're having practically planar charts for two measures. One of them would be time, the scale of time, and the scale of price, right? And hence we can present any information taken from the financial markets to present them in the form of two factors to the data presentation. That would be the time and price. So we can read how price changes over the time. And we are having different sets of charts. and one of them is a linear chart, right? The linear chart, that would be practically, and like every element, every part of the chart, every point to the chart would be, let's say, depending on how we choose that for the settings to be, that would be the close price or the open price, right? Or just medium, or like an average, or highs, or opens, close, highs, lows, and so on. So we can all adjust it the way we want, but the most frequently used option is to present the linear chart where every point is correlated with the close price for a given session, right? And apart from that, you're having the bar chart. The bar chart, that is very often used as well by market participants, by chartists, by technicians. That would represent the set of four elements of data, again, in a similar way that candlesticks do. The open price, the close price, the high and the low of a given trading session. And if we present that in a different form, the same set of data practically that Munehisa Homa invented in 18th century in Japan, then we could come up with candlestick charts, right? And in candlesticks, we're having these candle bodies and shadows, the upper and the lower shadow to that. So we're having the candle corpus or body, and that is limited from the upwards or downwards, depending on the color of the candle or the way that it closes above the open or reverse, right? Among other ways to present data of financial markets would be the point and figure chart. That is a different way to present the data that is not necessarily often to be noticed by simply people don't use that frequently, right? This is another system practically to be able to track and record the price movements, the price history, but this is not necessarily always competitive anyhow, because it lacks of some key information that are traded on the basis of for traders. And moving on to measures, to the indicators and the systems chapter here, we need to realize that we can try to actually be able to put some numbers into technical analysis. We need to be able to measure some samples, measure some data, some information, and the changes, and for how it changes, right? And hence we were presented with indexes or indices, however you call that. Let's take into consideration, let's say, S&P 500 or Dow Jones Industrial Average, right? So the Dow Jones Industrial Average is a kind of an invention, an index that is, that was an invention of Charles Dow, 19th century practically, and the reason behind it was that Charles Dow was posting his market analysis, his market news practically in his Wall Street Journal daily, and he actually was able to notice some kind of trends appearing. If you compare different markets, then you can see some correlation between them, right? And so then after he was pretty much spotting some repetitive patterns, trends, phenomena throughout different markets and different like cyclic ways, let's say, events that companies take into consideration for Dow Jones Industrial Average or S&P 500 for now, were actually presenting. So the performance of the companies were practically changing in a cyclic way, for years, for decades, that they were doing good, better or worse throughout some time at times. This would make him the charts. This would make him spot different ways to actually see that there is a strong correlation between the markets, and that if one market changes their conditions, then it should practically assumably change the conditions of another market that is correlated with that. And the stronger the correlation is, naturally, the stronger the effect would be. And to be able practically to track and record the overall performance of the whole industry, of the whole economy, practically, we had to gather that in the form of indexes, right? That would actually take into consideration and discount dozens and hundreds of companies to be able to spot trends and cyclic phenomena. For indicators, right? For indicators are tools, are technical tools that indicate us, something to us practically. So let's say an example of technical indicator would be a volume, right? So if we go and try to see the volume for a trading session, for be it a day, be it 4 hours, right, or be it a month. So this would take the actual, number of trades taken within this period, right, and present it with a bar chart most frequently, or linear chart, right? You can use that the way you like. And then you could see some trends in volume as well, right? So indicators would indicate to you practically the ways that people are trading the given market. And different types, I mean the specific type of indicators goes for oscillators, right? Be it RSI, be it stochastic, be it MACD, the moving average, convergence and divergence, by the way. And these oscillators are types of indicators that are practically oscillating per the name, and which means that the value of this indicator, being the oscillator, fluctuates from the minimum values to maximum values that are mathematically mathematically presented to be the edges practically. And if you gather all of these, if you gather all of indicators, oscillators, and bind them all together, mix them, then you can come up with some trading systems, with technical systems that you can know under the names of moving averages, Ichimoku, which is from Japanese, meaning practically at the very first glance, right? Bollinger Bands, price action, Heikin Ashi, like different types of systems that you can practically use to trade the given instrument with. And here you can spot some stochastic RSI, let's say, oscillations, right, or stochastic whatever, some oscillators, which means that there are cycles as well, cycles coming from and ranging from local undervalue and overvalue for the market, right, that will be presented in oversold or overbought state of the market, so called. And here you can see the regular candlestick chart, while below practically there is a smoothened Heikin Ashi chart that is smoother simply because it allows you, and this is presented in a way to discount only practically the stronger trends, right? While candlesticks or be it linear chart as well, are more or less at times, I don't want to call it a mess, right? But they tend to bring much noises for volatile markets. Then to be able to practically spot trends and trend reversals, because these are the objectives to be practically forecasted for technical analysts, then we can use and smoothen these to reveal actual trends behind them, to be it Heikin Ashi chart. And practically coming down to highlights and challenges of technical analysis, because there is nothing in the world that it would be only awesome, right? I mean, every activity, every event, every phenomena would always come up with pros and cons, with its advantages and disadvantages, pretty much, right? So as we need to understand that we can spot that easily and understand that easily and notice that all over the markets, all over the people and investors, participants of the markets, and how the way that they behave. There are both. There is a both for and against technical analysis as a part of knowledge, as a part of gathered experiences, knowledge for how it works and whether it works at all or not, right? So the question is whether technical analysis can be effective, right? And the answer is yes. Obviously, it can be effective, and the effectiveness defined by the actual fulfilling, if you fulfill your goals that you want to reach, and the level that the goals are compromised, we can call that an effectiveness, right? We can call that an effectiveness for which is the ability to fulfill the goals assigned, and or goals or tasks assigned. So the question for it being the effectiveness or not being an effectiveness, we need to realize that it all depends on the way you use that, right? Because I keep hearing per the very last point that technical analysis doesn't work, right? And this is most frequently coming out from the mouths of inexperienced people. Like people are these types of creatures, living creatures, that they would practically say most at fields that they completely know nothing. And so the less you know, the more you speak about it practically. So most frequently, to the best of my experience at least, the most people saying that and claiming that technical analysis doesn't work comes from it all comes from practically from the people that are not experienced at all, be it not experienced or not being able to use it properly, right? Because if you can use properly the technical analysis background, if you can align that with fundamental and sentiment or intermarket analysis, it's all working in an awesome way, right? And so yeah, it can be effective, but it depends on the person, on the party using the technical analysis, right? If you're using math in the wrong way, then it's simply not effective, right? But could you call mathematics to be ineffective? And so yeah, obvious answer to that is no. We cannot really call the mathematics to be ineffective because of the fact that you cannot reuse that, right? Or that you cannot calculate some equations. For the trends and cycles, like for the highlights, right? We need to realize that technical analysis provides us with the ability to read and to show and prove and present trends and cycles, and with these we are able to practically make money, right? Because technical analysis is completely not the very same activity as trading, right? But if you are a successful trader, then most often you need to realize and understand the technical aspects of financial markets. And being a market technician, being a chartered market technician, or chartist or technical analyst, however you call that, you are able to spot trends and cycles, right? That is giving you the edge in your trading practically over the majority of the market, because majority of the market, if you compare that with a normal distribution, would practically know least, right? And there would be both extreme types of parties to that, the ones that know completely nothing, and on the opposite part, there would be those that are badass and pros and professional chartists, whatever. And apart from these, the advantage, another advantage of technical analysis is the fact that you can compromise all these and use them in the form, the different techniques, the different assumptions, ideas, hypotheses, and if you know all of them, you can use them successfully. That it all comes with some trading systems, right? Which are the ways to interact with your technical knowledge, with your technical charts, to be able to trade it, successfully and make money and earn on this, right? And this set of data, the fact that it can be definitely effective if you can use that properly, the ability to spot trends and cycles, the repetitive behaviors for the market participants, the behavioral extrapolation of trends that you can as well project with some form of probability. The fact that it brings the trading systems gathered all together, that you can mix different indicators and trading techniques, concepts, technical concepts. It all comes with the positive sides to that. And as I said, on the opposition to the positives or technical analysis, there are the random walk hypothesis theories, right? This is a funny story. I actually had once a conversation with a university professor, the actual lecturer, the professor, being, practically presenting the lecture over behavioral finance. And I asked this guy whether he believed in technical analysis or not. And his answer was obviously no, obviously from his perspective. And he said pretty much like this is 50-50 chances that the price would go up or down. And this is true to some extent, right? Because like this is very most often interpretation, like misinterpretation of technical analysis and the facts, whether and the assumptions whether it works or not. Because you can compare that to the mathematical even or in whatever a probability event that you roll a dice. So what is the probability then there comes aside for the dice to be 1 point, to be one eye. And so this way, with this interpretation coming from this way of interpreting market technical analysis, it would be 50-50 because it either comes to be 1, right, or not. So you get 50 chances that it is 1 or not. And which is completely untrue, obviously, because the probability of that would be 1 out of 6, the 1/6, right? So hence we prove, like I didn't argue with this guy. I just wanted to pass my exam, so so I gave it a go. I think I gave it a rest, a pass. So but definitely this is a misinterpretation, right? On the very same way, there are probabilities. Like technical analysis is a game of probabilities that you can spot. If you can spot most probable patterns, most probable extrapolation of behavioral aspects to the trends, like the way that people may behave in the future based on what they see in the past, then you simply go and play with probability games, right? And so this is all about it. The technical analysis lets you and allows you to find most probable cases. And if you are able to spot most probable cases, then it means you're playing with good probability ratio, and hence make money on that, right? You can bet, because trading is betting practically. So you bet with the market counter market participants, but the market would go up or down. And this is all combining the demand and the supply for financial markets, as we said already, and inaccuracies of emerging markets compared to regular market projections, right? So the higher the volatility is, the more investors there are, and in fact, most, let's say, I don't want to say adult, but most experienced traders would not necessarily seek for and search for most volatile markets, because they know that it all comes with high risk, right? So depending on the risk profile of the given investor, that they may like it or not necessarily. So we need to realize the fact that per se cryptocurrencies as a market, as a type of financial market, would not necessarily compromise in the very same way the technical analysis rules and principles, if you compare them to regular markets, where the volatility is limited because it's all more regulated and so on. And so like the very most basic, I assume, difference between these would be the fact that regular markets take it, be it, I don't know, stocks, be it commodities, futures, on commodities or futures on indexes, right? Whatever. That these are not working on weekends. Okay, they're having their technical breaks pretty much on weekends, while crypto market is practically 24 hours per 7, right? So this fact alone is influencing the market in a way to be more volatile, to be more inaccurate if we perceive that to be the same, let's say, phenomena and place to space to make money if we compare that to regular markets. And we need to realize, as I said, that emerging markets, especially strongly emerging markets, that the whole blockchain technology and the whole blockchain background for cryptocurrencies is coming, and being very popular among the fintech companies, the banks. This is a technological part. They need to. I mean, they already realize that banks and so by this time used models need to be adjusted to actually be able to compromise and combat for them or use the blockchain technology, right? So it all makes it the very emerging market for cryptocurrencies, and hence the emerging markets very often they tend to move in more aggressive ways, which brings the volatility, which brings very often the exponential trends instead of linear trends, right? So this is this part. Is it a fortune telling scam for the blind to only make money on you? This is obviously answer to that being a no. And for the reason I already covered in effectiveness point, right? Whether it can be effective or ineffective. And the fact, if you can use that properly, the way you use maths properly, I assume, I hope, then you would be able to spot some key swings to the market. And every swing in the market, every market swing practically brings the greatest risk to reward ratio. That is the main objective, to keep it good, to manage the risk practically for every respectful trader. And so yeah, this is not a fortune telling scam. If you can use that properly, especially on less volatile markets for like forex or commodities or stocks, right, or even bonds, then yeah, you can project that quite easily with some good probability. And yeah, technical analysis doesn't work. It does work if you can use that. Mathematics doesn't work, but which is completely false, right? Because the ones that are saying that it doesn't work is simply because stemming from the fact that they don't know shit about it. So same goes for technical analysis. So going for a short summary for that, we need to realize that the whole concept of technical analysis is common for the definition of the price history study for that. And it includes the mix of sciences for behavioral economics, for sociology, psychological aspects, mathematics, to be able to quantify these all phenomena. And the history reaches to back in 18th, 17th, 18th century or 19th century for America part. And different types of financial markets, including cryptocurrencies, it all means that every, let's say, type of a market would be slightly different to another. And this way we cannot practically trade, let's say, cryptocurrencies the way that we would trade forex, the foreign exchange, right? For the other currency pairs, let's say New Zealand dollar to US dollar, right? And so this is completely misunderstanding if you want to use exactly the same rules and assumptions for financial markets, for all the types of financial markets, simply because you would get disappointed and say the technical analysis doesn't work, right? Yeah, this is pathetic. 3 principles of technical analysis: the market that discounts everything, the trends and cycles. We need to all realize all of these principles to be able to uh, to be able, obviously it's, it's much more than this, but these are like the main ones, the key principles for technical analysis, and the most important phenomena are trends and cycles practically for that. Different types of charts and indicators, be it candlesticks, linear, bar charts, Heikin-Ashi charts, different types of presenting the data, of data presentation, or just points and figures that are not necessarily often used. The pros and cons, as we said, if you can use that properly, then it just works, right? Then it works. And yeah, guys, yeah, this has been my honor to present you with the very first episode of Weekend Trading School, and we are just getting started, guys. Give it a credit for John J. Murphy for technical analysis of the financial market. This is an amazing book and very often so-called Bible for every technician to the financial market. Investopedia.com, this is amazing source of knowledge, stock charts as well, and Burb Nest, obviously for our own material. And yeah, give us a follow, guys. Don't forget about it. Support us the way that you can. It provides us with new strengths, with new sources, with new ways to actually be able to develop this whole startup. And this is amazing, guys. I mean, give it a follow for me, for CryptoBurb on Twitter, for the Burb Nest. Don't be afraid and don't be shy to share it all over your social media. Let the world hear about us. TheBurbNest.com and our link to Discord, right? And don't forget that you can all sign up for $9.99 for our modular packages. That is training therapy that successfully started for the very first issue as well today. Congratulations to Cityfied. Give her a follow definitely, and the follow definitely for any member to the Burb Nest. And Social Media Pro, where I could teach you how to become a social media pro, per how it sounds. And the Weekend Trading School, guys. I mean, it was my pleasure. It was my pleasure to host you for the very first episode of Weekend Trading School. And this is just the beginning. We're barely getting started. It was a pleasure, guys.